This is called everyone failures right here because listen, these are universal failures. You'll make one of these failures because it's universal. And I will go over these failures on a chart. Confirmation. This probably was my most recent dumbest mistake, bro. But it's okay because I wrote it down. Always going up, but stocks always go up. So you need to be an investor in stocks before you start trading stocks. What is up, YouTube? Okay, today we finna do a great video. Yesterday I was thinking, what should I do? What should I do? First thing I want y'all to know is I'm not a financial advisor. I just have good information and good knowledge on the stock market that I want to share, and I want to teach the world a little bit. But yeah, so this is called everyone failures right here because listen, these are universal failures. You'll make one of these failures because it's universal. But I started investing at 18. I'm 24 right now. The reason I started investing at 18 is because I was in the Army. 3 to 6 months in, I was like, bro, I ain't doing this shit for 20 years. What can I do to retire? Then I started getting into business. Then I started learning about the stock market. Then I went on deployment, so I ain't had no choice but to learn about the stock market because I ain't got nowhere to spend my money. I need something to do in my free time, and I want to get the fuck out the Army. So, you know, I was pushed into it, but I was like, at the same time, I always like saving money. So it's like, damn, it go hand in hand together. You save money, it's gonna make it work for you. Just avoid these failures I'm about to discuss, and I will go over these failures on a chart. Okay, first thing first today. Everyone fails at investing in one sector. Okay, listen, as an investor and as a beginner, you might have the nerve to invest in one stock. If you're going to invest in one stock, you want it to be an ETF that holds multiple companies. Look, this ETF, the SPY, it holds 500, it got 504 total holdings. It holds the biggest, most successful companies in the US stock market. This is something that you want to have. This is something you want to be diversified in, because if you don't have a good ETF that's solid, that shows, okay, this ETF shows it's been increasing since, the 1900s. What ETF has been increasing since the 1900s? VOO, you got more ETFs, but you want a good ETF. Because listen, during economic cycles, a certain sector may not be bullish. The technology service sector is bullish now, but that don't mean it will be forever. So when you diversify, your account will always be growing somewhere. If you got gold in your account, gold will be rising. If gold not rising, the SPY gonna be rising. If SPY not rising, NVIDIA gonna be rising. So you get what I'm saying? The more diversified you are, the less risk. But then again, as you see, you don't want to be over diversified, like number 4. Another thing is selling too early. A lot of people make this mistake of selling too early. I'm gonna break it down, give you an example really fast. Okay, check this out. Say APLD, you wanted to buy APLD right here at this support level, right? So you got filled at $3.76. Okay, I brought a penny stock at $3.76. Okay, I'm gonna sell out once it doubled. Okay, it doubled at $7.40, which is cool. You doubled your money. But according to my failures and everyone's failure, we all sell too early. Honestly, listen, you gonna sell it before it hit this. I ain't gonna lie, you're gonna sell it before it hit this. But once you master holding it to the end of your take profit, then I feel like it's another level of mastery, which is letting it run still. Because as you can tell, look, okay, this is the 2200 EMA, okay? It went up to take profit and it came back down a little bit, and then it ran up to a point where we could have took profit when it 4x. It almost 4x. So look, you can use an EMA as a trailing stop loss, but I like trailing stop loss more than a take profit area. Not buying the dips. I messed up not buying a dip on the video. When I saw the video coming down to this level, I was like, oh my God, I was about to start shitting on myself. I'm like, the video falling, what I'm gonna do? I was holding, but I should have brought. The beginner me, the 18-year-old me, probably would have sold out. The 24-year-old me was like, bro, just hold because you know what it's gonna do. And the 24-year-old me, before I hit 25, I'm really finna be buying them dips. That's why it's on this failure list, because everything that's on this list, I'm already working towards getting better. You know what I'm saying? I've been working on this, for a long time. Focusing on quantity over quality. That's why I fucked up, man. I'm thinking like, okay, if the SPY got 500 companies, let me get 500 companies. So I'm getting 500 companies, and out of them 500 companies, I'm holding less of them up to a standard of what they need to do. And IBM is breaking out. But yeah, back to what I'm saying. You don't want to have over 500 companies in your portfolio unless it's an ETF. You want to have like 10 companies or less. For your Roth IRA, if you got more than 10 positions in your Roth IRA, you got too many positions. You got way too many positions. You're focusing on quantity over quality. Not waiting for confirmation. So a lot of times I didn't wait for confirmation. Like with UPS, I was like, bro, when UPS get below $100, it's gonna be a good buy. So guess what I did? I brought UPS without waiting for confirmation. This probably was my most recent dumbest mistake, bro. But it's okay, because I wrote it down. Boom. But UPS did not show no confirmation of a bounce at $100, and I still got in just because I'm thinking macro level, $100 I'm gonna buy. But that's not the case. And then this is the biggest failure, not building my Roth IRA first and selling out of it. So when I was in the Army, I was building my Roth IRA with my employer. And once I got out the Army, I sold all the, took that money out. And the plan with that money was to invest it in the clothing business I had. So I invested that couple thousand into the clothing business, but I also took 50K plus loans out for the clothing business, and I swiped my credit card plus 50K in debt for the clothing business, and all that shit crashed. So the reason why I say this is build your Roth IRA first before you start trading, because when you trade, your account gonna crash. You gonna blow. Listen, be prepared. If you ain't start trading yet, be prepared to blow your account at least 3 to 5 times for real. Even if you enter the game and be like, bro, I ain't blowing my account, start with an amount you don't care about blowing, because if you blow your account 5 times, you got to think about it mathematically and strategically. If I blow $100 5 times, that's just $500 I'll keep investing. If I start my account with $500 and I blow it, I might not never start back investing because I lost half a grand and I would never be able to make it back. Don't go too crazy. Don't over leverage yourself. Don't go too crazy with the trade, and build your Roth IRA first, because the Roth is going to be safer, because stocks always go up. From the past, the future, they might keep always going up, but stocks always go up. So you need to be an investor in stocks before you start trading stocks. And don't sell out, bro. Don't sell out. Don't be like me. I guess if you're gonna sell out, if you selling it and it's gonna make you more APR, higher return, go ahead. But if not, nah. But boom, here are my winners, man. Patience and discipline to sit on your hands. Especially with gold, I just been buying gold since last year. It just been sitting on my hands, and as you can see, it's high as hell. It's up right now, and I just been patient and disciplined and sit on my hands. Always having take profit and stop loss plan prior to entering trade. You always want to have a plan before you enter something. Know when you're getting in, when you're getting out. Like with CNC, I don't have it marked up. But on this screen at least. But I've had it marked up before I even entered, and I already knew my plan once I got in. Like, okay, boom. It shouldn't break below that. That's 30%, okay. And it's running up, at least here, at least to there, So that's gonna be another 70%. But like I said, should I even take profit there? No. If it hold there, or depending on what kind of structure it has once it do get up here, then that's gonna determine if I hold it where I hold it at for taking profit, because taking profit right there too early. Measuring every risk. That's what I just did with this. If you want, like, don't invest in something you don't know the risk. Like when you're buying a car, what's the risk? How much value is this car gonna lose? 30, 40% in 1 year? Okay, you need to know that same thing if your stock gonna fall 30, 40% in a year, you need to mentally know that. If stocks do fall 30, 40%, especially SPY, it's gonna recover. If a car falls 30, 40%, man, that shit gonna keep going down. So stop buying cars and keep buying stocks, you feel me? But yeah, let's keep going. The more you buy good dips, the more you make good profits. I showed y'all this with NVIDIA. NVIDIA is a good company. It took a good dip. I could have made good profits, but nope, I kept holding with my average like around 113, when I could have got my average below 100 bond. I need to cut this off. That's the wrong one. But buying at demand zones lower your risk. So you want to buy at a demand zone. Let me show y'all real fast. Like UPS, this is a demand zone. If you buy at a demand zone, there's no way you can risk a crazy amount of money. Cause look, check this out. If it leave the demand zone and it break 20, and if it don't hold 20%, I'm out. That's just 20% risk for a major return. Let's see what the risk say. Keep an options contract 20% or less of my account. If you're a beginner, don't have 20% or more of your account in options. This is why, because options are 100 times more volatile than shares. Instead of losing $1 on a share, you might lose $100 on a contract. So in that sense, in that case, say your account starting with $500 again, we're gonna use that $500 analogy, and you buy 2 contracts and they 200 a piece. So now you got a $200 position, another $200 position. If they drop $1, you lost $200 in 1 day. You're gonna be like, bro, damn, how did I lose $200 in 1 day when share price dropped $1? Because you don't understand the Greeks of the contract. If you don't understand the Greeks of the contract, you don't need to be over leveraging your account with the contracts, you know? So if you keep the contracts 20% or less of your account, you'll blow your account a lot less. I'm telling you. Like I said earlier, you're gonna blow your account 3 to 5 times. If you keep your option contracts 20% or less of your account, you will blow your account 3 or less times. But once you go above that, that's when that, you know what I'm saying, more risk comes. But these are my 12 investing tips as a 24-year-old investor. Appreciate y'all for checking it out, and I'm working on this side every day. I'm perfecting this side every day, and bro, we're gonna be the best black investor one day, man, for sure, for sure.